Excellent. Good afternoon, everyone. My name is Bill Hanlon, and with me is David Bazar. David is our FDIC expert, and I am chair of Seyfarth's bankruptcy department. We have breaking news, and we're going to go through today what's changed with the situation on Silicon Valley Bank. Next slide, please, Colleen. What has changed? Well, on Sunday, Signature Bank, a New York commercial bank, was closed by the New York banking authorities. This prompted a government response from the FDIC, from the Federal Reserve, from President Biden, and they decided, instead of the prior plan to make FDIC insured deposits of up to $250,000 available to each depositor, to cover all the deposits at Silicon Valley Bank. And that money is available to depositors today, Monday, March 13th. They have approved similar actions with respect to Signature Bank. And this effort is designed to instill confidence in the U.S. banking system and to prevent further runs on the bank or other banks. Next slide, please. So a few words on mechanics. On Friday, the FDIC announced the formation of a bank. They've now changed that, and they are announced the formation of Silicon Valley Bank N.A. It is a so-called bridge bank, and it's going to operate for an undetermined amount of time. Silicon Valley Bridge Bank and Signature Bridge Bank. Mechanically, depositors and borrowers will become customers of the new FDIC-run banks. They'll be able to use their ATM cards, their debit cards, write checks. Their checks will clear. And this is important. Loan customers are encouraged to make their loan payments regularly and not to fall into default, which is advice from the FDIC with which we concur. Next slide, please. Everybody asks, is this a bailout? Well, kind of depends on your definition of bailout. David, you want to say a few words about whether this is a bailout?
Sure. So if your definition of bailout is the government paying for all this, then it's a bailout. But if your definition of bailout is the government ultimately going to pass all of this along to the taxpayer at the end of the day, then arguably it's not a bailout, because what they're claiming is, well, yeah, okay, we've got to come out of pocket now, but we'll get it all back because we're going to sell off these assets and keep them valuable, and we're going to impose a special assessment on all the other banks. So that's kind of a tax of its own kind, because it's going to push up bank prices, but they won't call it that. So we'll just charge the banks, you know, so what? They're big banks, they can afford it. And we'll go sue everybody who was potentially at fault for these institutions failing, and we'll do that under our FIREA authority as the FDIC as receiver, and we'll all be happy at the end of the day. Nothing to see here.
Well, you know, 2020 vision is available in hindsight mode, and I think there will be some allegations out there that maybe putting the bank's money in low interest bonds in a rising interest rate environment was not the greatest idea. It'll be interesting to see how that all plays out. In terms of who's going to suffer a loss, the depositors are protected. The shareholders of Silicon Valley Bank are not protected. and the unsecured creditors of Silicon Valley Bank are not protected by the government. So I suppose there is a limit to the extent of the bailout. But the good news is for depositors that they will have access to their funds, and they're not likely to suffer any loss of their funds that are in the bank. Can we have the next slide, please? So, who's in charge? The Silicon Valley Bank senior management has been removed, and the FDIC has named Tim Mayopoulos as CEO of Silicon Valley Bank. Mr. Mayopoulos is the former president and CEO of Fannie Mae, Federal National Mortgage Association, and most recently served as president of Blend Labs, which is a fintech company. He's also had positions as a lawyer with other banks. And Greg Carmichael has been appointed CEO of Signature Bank. Mr. Carmichael is former CEO of Fifth Third Bank Corp. In terms of operations, staff at these banks is likely to remain at least until they can land jobs elsewhere. You have a bank that's going to run for a limited amount of time. It's unspecified, and we can, I think, expect to see some attrition from the ranks of the staff at SVB and Signature Bank. That will contribute to some of the hardships in transitioning the bank's assets. So now that we know who's in charge, what's their mandate, David?
Their statutory mandate is to protect the taxpayer. So what they will do is they will seek to sell the banks for their maximum value, which would be as ongoing concerns. And if they cannot strike deals in relatively short order that are good enough deals in that fashion, then they will seek to break the assets up and sell them off as separate assets and not as ongoing concerns, meaning that the banks will not transition to a new bank. They'll be cut up into little pieces and sold.
This is kind of an old school approach by the FDIC, isn't it?
Yeah, this is exactly the way they used to do things before the Dodd-Frank vision of the world, where we just try to step in and keep the status quo, because the equity holders are going to get wiped out in this, and creditors get 90 days to put in a claim under an administrative claims process to potentially get some or all of their money back. It can be extended to 180 days for the up to 180 days for those claims to get processed by the FDIC. So this process goes fast.
And it's a non-judicial process, isn't it?
Completely non-judicial. Yep.
Yeah. Can we have the next slide, please? So in terms of expectations, what do we see coming for the new banks? I think in big picture, we would expect those depositors who can disentangle themselves from the banks likely will. And I think that expectation would be one that is shared with the FDIC. And while they might like people to hang around for a while and leave their money in the bank, I'm not sure that even though the banks have the full faith and credit of the U.S. government behind it, I'm not sure that that's going to happen. Would you agree, David?
Yeah, just for the reasons you mentioned, that these banks are deteriorating right now. Their customers are going to leave in droves. Their employees are going to start walking out the door and finding new permanent jobs. These banks are literally coming apart at the seams. You just don't have to worry about losing your money in them.
Agreed. You know, here's where the rubber is going to meet the road is with the depositors who really can't untangle themselves right away from the bank. It's borrowers that have perhaps low interest rate loans with the banks. It's borrowers with lockbox arrangements. It's borrowers who are required to keep their deposit accounts at the banks as a condition of their loan. And it's borrowers with unique banking relationships of the kind that Silicon Valley Bank sold itself on. You know, we're flexible. We're not your regular bank. We're not your grandfather's bank. We can work with you. We can do different things. Well, since these banks are deteriorating and since the receiver is appointed and managing the banks, the decision-making process at Silicon Valley Bank will be slower and more complicated and more difficult to navigate for those borrowers that need to extricate themselves and have a more complicated lending relationship. There are hotlines set up and guidelines for contacting the FDIC in case of special needs like lien releases. I think that borrowers with these relationships will experience delay and some degree of frustration in getting these approved. So as a general matter, we expect that those borrowers that are tied to the bank tightly and who can refinance their debt will do so. And for everyone else, it's going to be a little bit of a struggle in the next weeks and months to extricate themselves. Comments, David?
Yeah, the only thing is you know we've already seen how fast this can whipsaw. I feel like I've got a case of double whiplash from Friday to today, and of course, you know, if some white knight comes forward and purchases one of these institutions, lock, stock, and barrel, and it's a big, healthy financial institution that the public has confidence in, then all, you know, everything might go off happy, and everybody's like, oh, I'm perfectly happy to be a customer of that bank, and there's a little bumpy transition period like there will be, but you know, folks will go on, and you know, all the employees will get offered jobs by this bigger bank or whatever, and everybody will be happy. But you know, we just don't want to rely on that. It's just no one knows what's going to happen. So, you know, the government hoped to auction off SVB on Sunday. Didn't happen. So, and I know like at least one big bank announced publicly, PNC, that it didn't happen with them because they made a bid and then they actually looked at the financials and went, don't want it, no. So you know, this could be. We just don't know how this is going to go or how fast.
I understand that the international operations of SVB were sold off over the weekend for the princely sum of £1. You know, it's really a question of whether someone, a purchaser, another bank, is willing to step into the shoes of SVB and continue what SVB started. The picture is nowhere near as rosy for those purchasers as it was even last week with SVB, because we really do have an expectation that a lot of the depositors who have access to their funds will leave the bank immediately, even though it's probably a safe place to have your money right now.
Right. It is, interestingly enough, a safe place to have your money right now, although you may have trouble getting the bank to do anything for you. They'll have the worst customer service in the banking world for a little while. But, you know, it's the longer this goes on, the worse, to Bill's point, the worse that it will deteriorate. So, If it goes on too much longer, it'll, the chances that somebody will be able to keep it going as an ongoing bank will continue to go down.
To our point earlier about paying loans, the bank has, and the FDIC is now in charge of the assets of Silicon Valley Bank. And as David said, it's going to be guided by doing what is best to maximize those assets for the benefit of the U.S. government, which is backing the bank. That means that we expect that they are going to be aggressive with loan collections and that borrowers should be careful about taking rash actions or knee-jerk reactions like, no way am I going to pay that loan. The risk there, and it has to be evaluated on a case-by-case basis, is that a borrower that takes rash actions could violate its loan agreements and trigger default provisions. That will make it a lot more difficult for the borrower to refinance, and it will make it much more likely that the FDIC will pursue that borrower in order to maximize the value of the assets. So anybody that's really in this up to their elbows or eyeballs, choose your metaphor, is advised to look carefully at their own situation, their own obligations to Silicon Valley Bank, because this world has changed today. And Silicon Valley Bank and the U.S. government is meeting their obligations under the deposit agreements with their depositors, and they're going to expect their borrowers to meet their loan obligations with respect to their loans. Any further comments, David?
Just that we've had a lot of questions about open line credit line mortgages where there's a line of credit, and can I get my line of credit feature? Will I get additional credit if I need it during this time period? And the initial answer was no. The FDIC has said no, except in very exceptional circumstances. But now that the contagion powers have been used by the federal government, they've redone that guidance and basically said they're going to try to operate this as a full service bank. But I would take that with a bit of a grain of salt. Plus, you may have a really hard time getting through to a decision maker to get the extended line of credit. So what we're advising everybody is that if you have a line of credit that you may need to rely on, you really need to get out and try to refinance it or to obtain an additional other line of credit, something, because you may not be able to draw your credit line in this time period.
All right. I see we had a couple of questions here. One of them is, what should we as a customer evaluate to choose a bank for deposits? I think as a customer, I would pay attention to how the market is evaluating banks right now. There are certain banks that are under pressure, and there are certain banks that are not under pressure. I don't think I'm not prepared to name names here, but I think paying attention to what the market is doing vis-a-vis banks may be a good guide. Any comments on that, David?
Yeah, again, without naming names, I think if you'll kind of go back to too big to fail, is you're gonna watch folks, except that they're moving money around, they're gonna move it up into those larger institutions. If that's the reason for their movement. And you're also going to see that federal and state banking regulators are going to become extraordinarily concerned about that very quickly, because it could decimate the middle banking system that they've been building out so hard for so long. So, it's going to be one of those stay tuned things.
It is. And I think that that's probably a good place to end this webinar, unless you have any further comments, David.
No, I mean, the task force, our task force is up and running. We've got a huge number of really talented legal professionals that bring various skill sets and experiences. I think we have combined hundreds and hundreds of years of relevant legal experience that is being brought to bear instantly. So, if anybody has any issues, we're responding to them with near instantaneity, whatever that word is. So please don't hesitate to reach out to us.
Thanks, David, and thank you all for attending.